Hey everyone, how's it going? It's Nick with Vant Trading here with another educational stock trading video. And today I want to talk about, well, while the market is rocketing higher or while it's rolling over, whatever your market situation may be, it's important to identify the stocks to watch and what stocks to avoid. How do you know what class of stocks are going to start bouncing or dropping with the market and which ones won't and will have their own independent order flow? And we're doing this because it's going to help you avoid a whole lot of pain by identifying the key stocks to watch and understand why some stocks are rocketing or some stocks are dropping harder than the market despite having good news. And this is a key topic right now because as the market is experiencing a lot of volatility over the last couple of weeks here as we drop lower, and today we saw a little bit of a bounce, we're seeing a lot of stocks out there that are either weaker than the market and not dip buying or stronger than the market and not rolling over. And by identifying these key classes of stocks and these key stocks, you're going to be able to understand why you need to be watching some of these stocks, why you shouldn't even be attempting to dip buy some of these guys, and why you shouldn't be shorting some of them either. Before we go in and start looking at some of these stocks and identifying them, I want to remind you all of one thing, and it's going to sound a little depressing, but we are the small fish in the market. We are the small guys, and unless you're talking about a low float stock here, some pump and dump, we are not the ones that move the stocks. Us day traders, investors, swing traders, whatever you are, it doesn't matter. We need to know what it is the big institutions are doing in the market, because if all of the banks and the analysts and the hedge funds out there decide to sell a stock and or decide to invest in energy stocks or weed stocks or tech stocks or small caps, then that's what's going to give those stocks the volume and the sustainability to move higher or lower despite what the market is doing. You need to understand capital rotation, and you need to understand what the market is doing and what the market is thinking essentially. And that's why we need to identify these classes of stocks, because then you'll understand why some are running astronomically while others didn't. And you'll be able to understand why some may be pulling back a lot more aggressively than the market, or others may be bouncing while the market is dropping. That's how you're going to be able to distinguish this, and then you'll be able to identify the key stocks that you should be watching so that you can make some money in the market. Now, there is also something important to note in that the beginning of this year to now, the market environment has changed dramatically for many of these companies. Many of their fundamentals have changed drastically. Some of them are in complete new areas of expertise. Some have a much larger market cap or share. Some of their sectors and industries have changed dramatically with quarantine and with online ordering and such. So that's important to take note of. And now while the market is crashing, some are still running. And some came out lately because we're in the middle of earnings season with record earnings, but they're getting absolutely smashed and punished by the market. Why is this? Well, we're going to talk about that now. So let's start off with, well, if the market is dropping or if the market is just kind of floundering about, one of the things that you can look for is identifying the stocks that are stronger than the market. Identifying the stocks that are holding up over days, weeks, months versus the market can help you identify that capital rotation. You might be able to see where the money is going into and where the money is coming out of. And when we're talking about stronger than the market stocks right now, well, I'd be remiss if I didn't mention Chinese stocks. And there could be a number of fundamental reasons why these Chinese stocks are stronger, but take a look at the SPY chart here. Clearly, we are coming off of the highs. We've had a very large drop yesterday, both overnight and during market hours. We had a little bit of a bounce today, but we're not worried about today. We're looking at this overall move. Now look at a stock like, say, Baba. Alibaba is sitting at the highs. In fact, it's still testing these all-time highs. Alibaba hasn't even blinked. And while, yes, it may be weakened slightly by the market or have other headline news issues, Chinese stocks like Baba and like JD and like NIO have all been holding up better than the market while the market is crashing. Look at the SPY yesterday. We're going to take today out of the equation. Look at this massive gap down and this massive drop. Now compare it to a stock like Baba where we didn't even gap down, we gapped up. And we finished low, but not lower than the previous day's low. And look at NIO. Yes, it broke out today, but look at yesterday. That's not a weak day. That is not a weak stock compared to the market. And then look at stocks like JD and Baidu, which haven't broken out yet, but they're just hanging out up here. These Chinese stocks are all looking a lot stronger. And so identifying that could have helped you capture something like a giant move in NEO today, where we saw that massive breakout with the market moving higher, or that nice pop that seems to be coiling in BABA. BABA seems getting ready to break. And yes, it could tank from here. Some headline could come out, but this is how you identify your classes of stocks stronger than the market. Now, what about some other stocks? Because we don't necessarily just want to trade just the Chinese stocks, because then you're prone to other risks. There are stocks out there that are holding up better than the market. And while, yes, if the market is tanking, it will most likely drag every stock down with it. To an extent, there are stocks holding stronger. So, for example, when we look back at the SPY has cracked through the 50-day simple moving average and the 20-day simple moving average. It's almost approaching the 200-day simple moving average. Look at, say, Walmart. Walmart is weak, yes, and it's rolling over with the market, but it's holding up a little better here. We're holding above the 50. We're trying our best to hold up, and while I wouldn't blindly buy, it is something to take note of, that Walmart, while the market was dropping in March, Walmart's not going to lose business. In fact, if people are losing jobs, Walmart's probably going to gain business, let's be honest. Look at a stock like Corsair, and while this IPO'd recently, and this isn't the best day trading stock, this stock hasn't even budged from the highs, and you need to understand why. And now let's also look at some other market stocks that are holding up, like Twitter. Twitter actually broke out to new highs today despite the market dropping yesterday. And Facebook's been holding up pretty well here as well. We're not at the highs, but we haven't dropped by any means. And now you also need to understand and identify that Facebook and Twitter are holding up for entirely different reasons. The elections are going on right now. Everyone's taking to social media for their news and for their opinions and whatever. There's a whole bunch of campaigning going on social media, so that's obviously going to boost their revenue and their uses and such and make them a lot stronger and more popular. That is something to keep in mind, and it could be only temporary. But by identifying the stocks that have been holding up over the last days, weeks, months versus the market can help you identify where capital might be rotating into or rotating out of. Now, I mentioned stocks rotating out of, because there are stocks out there that have been selling off prior to the market, that way before the market started dropping. And this is how you can avoid the stocks to dip buy. These stronger stocks like Facebook and Twitter, you obviously don't want to be shorting these things right now. They're breaking out. Yes, the market might be rolling over, but these stocks are stronger than the market for a reason. If you saw NEO failed to drop yesterday and you're like, oh, NEO needs to catch up to the market now, and you tried to short it today, you would have been blown out. Now, on the other side of things, the market is had a little bit of a bounce today. We had a nice little move off of the lows from yesterday. There are stocks that you should not have been trying to buy, and there is a reason for that. For example, stocks like Intel. Intel just had abysmal earnings. They are slicing through support levels. They're at these yearly lows. They are way weaker than the market. There is no reason you should be trying to dip buy Intel until you get confirmation. Now, is Intel going to zero? No. Do you need to wait for some confirmation where those buyers are actually going to step back in? Yes, because just blindly dip buying just because the market is going up is not going to work with stocks that have been selling off way earlier. Yes, you may dip buy some of these stocks at some point, but it's going to be way later than you're trying to right now. Let's look at some others. Draftkings. Draftkings has been below its 50-day simple moving average for several weeks now. Draftkings peaked out back at the beginning of October and started selling off immediately after that. In the beginning of October, we were still pushing higher in the market. That is a key distinction. Draftkings, has been selling off. You should not be dip buying Draftkings in here just because the market's been holding up. If you started dip buying Draftkings while we're dropping here just because the market was stronger and going up, you would still be underwater pretty significantly. So you need to identify that sometimes stocks are weaker for a reason, and they're not necessarily going to zero, but they are pulling back. Beyond Meat is another example. This is a stock that has had a tremendous run lately. It almost doubled since early September. You should not be dip buying Beyond Meat. Beyond Meat went down today. It broke the 50-day despite the market going up. And you can see that weakness compared to the market that we've been tanking off here, and you need to be patient with these stocks especially. That's just more reason. Let's look at another stock, Boeing. Boeing actually beat expectations on earnings yesterday, and they went down and cracked. Now, yes, part of that might be because the market was weak, but obviously look at Boeing's chart. Boeing's not going up right now. Boeing is in the dumpster for a reason because its market has fundamentally changed. Airlines are struggling tremendously. Militaries aren't buying up planes because their countries are too busy putting out money for stimuluses and trying to stabilize their economies. Boeing is struggling financially and fundamentally, and they've been weak because of it. You don't dip by Boeing here yet, especially as we're cracking lower, just because they had good earnings or because the market is going up. And this is a good example of how you could have hurt yourself. You need to wait for Boeing to show that to you. Now let's identify some other classes of stocks, because let's be real, there's a couple stocks out there as quarantine hit and the quarantine stocks have been running. There are some stocks that have just gone too far. Let's be real, let's be honest. Some of these stocks have gone up tremendously, and they shouldn't be up here fundamentally or technically speaking by any means. And now it seems like the big capital and the money might be realizing that the ride is at an end here, because we've seen some stocks that came out recently that came out with really good earnings or really good headlines that have gotten absolutely punished. And this is my favorite one to look at, Overstock. Overstock came out today with monstrous earnings, surprising profit increases and sales beats. All across the board they beat. They got punished today. They went from 82 to 62. That is a massive, massive haircut. I believe that's what, 20% haircut, 25% haircut just on one day that they smashed earnings, and they finished at monthly lows. Why? Well, take a look at this. Overstock at the beginning of the year was a $7 company. At one point it was a $2 company. This thing went up to 130. And I'm not saying Overstock hasn't benefited from the quarantine. I'm not saying Overstock, doesn't deserve to maybe be a stronger company and a higher stakes company. This isn't, some people are going to say, well, Netflix started probably at $10 and now look at it. This isn't a Netflix. All right, there's a difference. This was spurred on by an event, and yes, it may have led to a fundamental increase, but going from $2 to 130 in the span of a couple of months, that, let's be honest here. And that's why on a day like today, that pop isn't a reason for market makers or hedge funds and the big players out there aren't going to see that pop there and be like, oh, this is time to buy Overstock. No. Overstock's been clearly weak. Now it would be different if we were sitting up here on Overstock, because Overstock's still in the middle of a strong move. It hasn't established any weakness. Overstock has established weakness. People aren't bouncing this stock anymore because they realize, I'm not initiating another position in here. I'm not buying Overstock, a $3 company, after it's already made this move and retraced 50%. Because you know what? This stock is probably coming back down. There's another one, Fastly. This was a $10 stock company or $20 a stock company. And I'm not saying these companies are BS companies by any means, but this one went from 20 to 140. That's a multiple of 7. This is a little extreme for some of these stocks. And Fastly, took a haircut here because they mentioned they were going to have bad earnings today. They had those earnings and they gapped up and they punished them back down. This chart doesn't look appealing to buy at all. I don't care if the market's bouncing. Look at this. No one wants this, and you can tell by the price action. A lot of these stocks, the capital is rotating out because they're realizing that, the ride was fun, the ride was out. A lot of companies, a lot of funds, a lot of analyst banks are moving to very heavy cash, or they're moving to some of the more established companies that we talked about, or the companies that are stronger, because look, we're coming into a tumultuous time. These very crazy elections are coming up. You've got a lot of uncertainty with COVID resurging, lockdowns coming back into effect. A lot of people are sitting in cash right now. Oil is tanking, gold is tanking, treasuries don't give any returns, bonds are tanking. There's no safe haven out there right now, and people aren't going to be putting that money into stocks like this right now, despite a good news gap. Let's take a look at 2 others, and this has a little bit of a difference to it, but we're going to look at 2 of the vaccine names. Novavax was a $3.50 company last year. They had nothing on the market to my knowledge. They did nothing. They traded no volume. The beginning of this vaccine craze, they say they're going to help develop a vaccine. They go from 3 to 190. Now, look, if through this move you are not to be blindly shorting a rocket ship. That's not what I'm saying. What I'm talking about now is while the market is dropping, and if we start catching a bid in the market, you shouldn't be dip buying stocks like Novax, because look at this. Novax is getting absolutely punished. If you were to say try to dip buy a stock like Gilead, Gilead had really good news a couple of days ago. Their remdesivir for the COVID treatment was approved by the FDA, and it gapped up pretty substantially, and it got smacked in the absolute mouth, and it's lower. It's at all-time lows right now. Why, if you were dip buying this in here on a good news, you didn't look at this chart. People have been selling Gilead since the end of July into August. This thing's been getting sold constantly. It is clear that no one is in here buying this right now, despite the market holding up. It's been much weaker than the market, despite the headlines, and so you can't be just trying to pick a bottom. Let others pick bottoms for you. You wait for the confirmation. So then when you see a stock like Novax, Nvavax, that was a $3 stock company, has been selling off pretty much since it peaked in August. You shouldn't be dip buying this in here until you get real confirmation that maybe you can momentum drive this one back up. Same thing with Myrna. I mean, this one's a little more established. It was a $15 stock company, but this one went up from 15 to 95. I mean, that's a multiple of what, 6? So that's pretty substantial here. But I want to also talk about some of the other stocks, because we talked about market stocks, the market environment changing for a lot of stocks. There are stocks that went up astronomically, that the market probably does like, but they're a little overblown. We're talking about the stocks like Peloton. Yes, Peloton is benefiting astronomically from COVID. Gyms locked down, people bought their machines, and they're probably doing very, very well for themselves. However, they've gone from 17 to 140. That's almost a multiple of 10. Now, I guarantee, I haven't dug through balance sheets and income statements and the like, and yes, these stocks are going to be, much more lucrative going forward. But we're starting to see them start to falter here. And Peloton's an interesting example because it is holding up a little bit here. So it's going to be interesting to see what it does, but it looks like it's starting to crack here because, look, people aren't going to start initiating new positions on Peloton at this kind of multiple of earnings. There's a good point here that someone mentioned, and that is, the market is in a very uncertain environment right now. People are selling because, look, the market is overvalued. People are looking for indicators to tell them, well, should I be buying stuff? And there's one big one that I want to bring up. This is what's called the Buffett indicator, and a lot of traders will use something like this to try to identify, overbought or oversold valuations in stocks. And the Buffett indicator hit a 2 standard deviation level on the market in general, versus their earnings or versus their market cap and such. And this is a level it hasn't reached since the internet bubble. And I'm not saying that this was reason enough to sell. It's been up here for several days. You could have been trying to sell and have had no luck. But this is a good example of stocks are, they're getting a little overvalued now, and people, you need to understand where people are not going to be rotating their capital into, and that is stocks like Peloton and Zoom. Zoom was a $62 company. It went up to $600 almost. That's a 10 point, that's a multiple of 10. Zoom's business did not increase that much, and it's not going to sustain that much. So it's not surprising to see Zoom start to come off. People aren't going to be dip buying this thing. You might get some momentum plays, and obviously price is king, and you wait for confirmation. But stocks like this have gone up too much. Look at a stock like Fiverr. Fiverr was $19, has gone up to $190. Another multiple of 10 here, and we're starting to see that pullback. Now, it's going to be interesting to watch if Fiverr can continue lower, if it holds up. Obviously, price is king. I'm not saying these stocks are going down right now. I'm not saying they're going to go down the next week or month. Price action can go for a long time, valuation be damned. But this is why, on days like today where the market's dropping or bouncing, these stocks aren't following, and you shouldn't be rotating into them. Look at Penn Gaming. Penn Gaming was a $3 stock company. Now, they did acquire Barstool, which does fundamentally increase their value. But from $3 to $75 is obviously a little much. Penn's been selling off like Draftkings prior to the market dropping. Yes, we got that gap up in Penn today on some news, and they punished it back down because no one is acquiring a position in Penn Gaming right now. The momentum's to the downside. It's obviously had a little bit of an overblown move. It needs to come back, capitulate, and then maybe it'll become more attractive for other investors. Now, there are stocks that whose fundamentals have changed that have gone up but haven't fallen, and that's because of the extent. Remember, we were talking about these stocks like Peloton, Zoom, Fiverr and Penn that have gone up in multiples of 10 or more. There are stocks like Logitech. Logitech's had a very nice year, obviously, for understandable reasons. It's gone up by a multiple, since pre-COVID of about 100%. That's a little more reasonable. They just had good earnings, really good earnings, which obviously popped them up here, and we're seeing some profit taking on that, which is understandable. But stocks like Logitech and Chewy are still sitting up here at the highs. Yes, they've gone up 100% or so, but their fundamentals going forward are stronger and they've changed. So this is a little bit of a borderline different story here. And like I said, with all of this that I'm saying, this doesn't mean that Bob is going up tomorrow. It doesn't mean that Bob is going up in the next month. It doesn't mean that stocks like Intel, Draftkings, Peloton, Zoom are all going back down. I want to show you a cautionary tale here, and that is our boy named Tesla. Tesla was this is obviously adjusted for the recent split, a $60 company last year that is now $450. It has not dropped yet. This thing has been overblown for a while. The valuation is absurd on the stock, where it's worth more than all of the other U.S. automakers combined, I believe, at the moment. Valuation be damned, these stocks can go on all sorts of different things. I'm not saying Tesla's a bad company. It's obviously a big boy, but the ratios that we've been seeing on some of these stocks are a little absurd, and this is why I'm just showing you why we're not seeing the stocks rotate the same way. When the market is dropping and dropping like a rock, you should not have been shorting stocks like NEO, BABA, Baidu, Walmart, Twitter, Facebook, these stocks that fundamentally are not dropping and have been stronger than the market. And when the market does eventually bottom and start to bounce, you probably don't want to be buying stocks that have been weaker than the market. The Intels, DraftKings, Beyond Meats, Gileads, Boeings. I'm not saying you never buy them. I'm saying you don't blindly dip buy. You wait for confirmation and you let others try to find the bottom for you. This has gone on a little long, so I'm going to call it here, but I just want you to get an understanding of how you should be thinking as a trader in the market. Whether you're day trading, swing trading, investing, whatever, you need to understand what the large capital is doing. There is clearly capital rotating out of stocks like Overstock, out of stocks like Fastly. They're unlevering their positions. They don't want to be so risk prone with such uncertain times, especially as the market is dropping. If the market was continuing to rocket up and you could buy whatever you want, great. That's a whole nother story. But while the market is uncertain and while we're experiencing this overvaluation on things like the Buffett indicator and everyone's looking for the top, you don't be shorting stocks that are stronger than the market, and you shouldn't be blindly buying and catching falling knives because they're dropping for a reason, because capital is leaving them. A lot of people are going into cash. So that's something to keep in mind. I hope that this has at least helped save you some pain in the future. And this is a lesson that you'll be able to take with you pretty much forever going forward in the market, because remember, we are the little fish in the market, and it's important to know what the funds are doing, what the real capital is doing, and where capital is being allocated. I hope that this was helpful and informative. Please be sure to like and subscribe and drop a comment if you have any questions on the video. I will be sure to respond to all of them. I will see you next time, and as always, safe trading.